I'm Howie Lim. This is Money Hacks by the Business Times. Feeling the need for extra income might lead you to consider taking on numerous side gigs or seeking a high-paying job. However, the solution could simply be to heed the wisdom of someone adept at investing. Using your money to buy different investments may seem easy, but becoming a successful investor is deceptively tough. And ultimately, let's say it together, who has the time? Many cash asset-rich professionals have the means to make substantial investments, but little time to learn or micromanage their portfolios. So are there simple and effective financial systems for the busy? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And the expert help today comes from Grace Tay, Associate Director at Finexis Advisory.
Thanks, Howie. It's good to be here. That's the dream, to be able to maximize returns and yet not have to spend a ton of time on it. That's possible, although it doesn't happen by chance. There are 3 key ingredients that needs to be present. So the first would be clarity. The second is to have a sound investment strategy. And the third is to have a long-term view to investing. So firstly, clarity. That's really about playing your own game, understanding what are your personal goals, the time horizons involved, as well as your own personal risk tolerance. People often make the mistake of playing someone else's game unknowingly. An example, Amazon back in the 1990s. Share prices were actually going through the roof. So it was a hot stock at that time, and naturally a lot of people piled in because they saw it as a way to maximize returns easily. However, come the year 2000, the dot-com bubble burst and stock markets tanked. With it, so did Amazon's share price. At one point, it lost almost 90% of its value. With that, I believe a lot of investors who got in because they saw a chance to make a quick buck, but did not actually understand how these investments would actually support their goals, likely they would have panicked and sold on the crash. However, for investors who had invested into Amazon because they saw a good business and had the time horizon long enough to ride out that short-term market volatility, if they were holding on to that stock today, they would be sitting on a 28,000% return. So that's a very substantive return.
Well, that certainly puts things into perspective. Okay, so we've got clarity, meaning what are your goals, etc., etc. What's next?
So that's the first thing about having clarity of your goals. The second thing is to have a sound investment strategy, understanding a few things. So the first is asset allocation, understanding which assets are most suitable to your goals, your time horizon, and your risk tolerance. Because there are some assets that are suitable for shorter term goals, others that are more efficient if you have a longer time horizon. The second thing is strategic diversification. So people tend to do one of 2 extremes. Either they decide to pick individual companies in a few industries, or they go the other extreme and they simply invest in an index. For the former, this requires a lot of time and energy, which busy professionals don't have a lot of. For the latter, on the other hand, it may seem very passive and broadly diversified, but often leaves a lot of returns on the table. So either is not ideal. My suggestion is to invest in a way that captures the global productive capacity, while also accounting for some of the key drivers of returns historically. The third ingredient is to have a long-term view to investing, as long as you can. Because the truth is that growing wealth through investing takes time. So if we look at the classic example of Warren Buffett, did you know that 98% of his 200 billion net worth today was actually acquired after he turned 60? And this is someone who has invested since he was 10 years old. So how long term? Of course, if you have the time horizon of Warren Buffett, 50 years, then you can reach 200 billion in net worth. At the end of the day, right, optimizing our investments is really first understanding why we are investing so that we can then build a portfolio that is aligned with our specific goals, time horizon, and risk tolerance. Because at the end of the day, investing should give you freedom and not a second job.
Ooh, I like that. So clarity, sound investment strategy, and long-term view. Yeah, for the uninitiated, it feels like there's so much to do and it's so complicated. You might as well get another job. What other pitfalls should busy investors look out for?
So there are 2 main pitfalls that I see busy professionals fall into when it comes to investing. The first is procrastination, which means that they put off investing because they are too busy. And the second is impulsivity or rushing in, where they feel very anxious that their monies are not working for them, and so they put it into the first popular thing in the investment community. The consequences of procrastination are easy to understand. The longer that we leave investing, the less time that we have to compound our monies. So Albert Einstein puts it very beautifully, right? He once said that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. On the other hand, rushing in or impulsivity, it's a little more difficult to understand the immediate implications of that, because there must have been compelling reasons why someone invested in the first place. However, as we saw with the Amazon stock example, if you don't have clarity of why and what you're investing in, the likelihood of making highly emotional decisions which leads to suboptimal outcomes is very high. An example of a client, he actually invested in the Tesla stock. In fact, he put nearly all of his net worth into it, a total of about $1 million. And long story short, he wrote the share price up, wrote the share price back down, and ended up in a worse off position. So what we did for him was that we structured his investments into something that was more resilient, diversified, and a core portfolio. Today, he still holds on to his Tesla holdings, but he sees it as more of a gambling portfolio. And that is one trick that we can use to avoid the consequences of impulsivity, and that is to have clearly differentiated portfolios. So a core portfolio for your non-negotiables in life like retirement, kids' education, healthcare, and then a satellite portfolio which can be your play monies. If you have excess funds, you can use this to make your experimental bets. Basically, it's money that you can afford to lose.
Still to come, what are some simplified strategies one can employ to at least get started? More with Grace Tay from Finexis Advisory in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. We've talked about how important clarity, sound investment strategies, and time horizon are. While I get there needs to be some effort and work put into it, are there simpler ways to go about it though?
If we are talking about simplified financial strategies that we can put in place, here are 3 that are useful. So the first would be a systematic review process. Generally, if your portfolio is built right from the start, you don't actually have to monitor it daily or even monthly. Once a year check-in would be sufficient, because the truth is global economies don't change drastically overnight. So the only thing that you would need to monitor is really if there's any changes to your personal circumstances or your priorities, and to adapt your portfolio accordingly. There's often all this market volatility. In fact, every year there will be a season of market volatility. But if you have set your portfolio up right from the start, for example, if you have put in place a sound investment strategy that accounts for the time horizon of your goals and your risk tolerance, all this short-term volatility is really just market noise. We should be more focused on the fundamentals of our investments and whether or not we have reached the time to cash out on our goals. The second one is to automate your investments. So once you get clear on what your goals are and you also understand what are the appropriate assets for these goals, the next step would be to automate the investing towards these goals so that you know that you are working towards your ideal outcomes in the background while focusing on your career and your family today. The third system is really to just work with a trusted advisor who can walk you through that journey, who can set up something that works for you, and who can help you to manage your portfolio on an ongoing basis. And that includes checking in with you at least once a year to see if anything has changed with your priorities so that we can adapt that portfolio and that strategy accordingly.
Nice! So systematic review, automate investments, and trusted advisor. And this would work with people of all financial literacy levels, yes?
I will tailor my advice to their level of literacy. Usually, I share 3 simple frameworks. So the first is a cash flow allocation framework that I call the $3 concept, to assign a role to every dollar so that we make sure that our resources are working towards our most important priorities. And we have clarity on which part of our resources are working for what. Some of these examples of priorities could include things like your retirement, kids' education, or even lifestyle aspirations or legacy. When I walk my clients through this exercise, they have the certainty that they are working towards their important goals in life. And oftentimes we find that at the end of the day, they do actually have additional dollars that they can use to experience financial freedom today, not just in 10 or 20 years' time. The second framework is a set of evidence-based, time-tested investment principles that tells us why and how we should diversify, how we should allocate our assets, as well as structures that we can put in place to minimize emotional decision-making. And the third framework that I often share is what I call my Kueh Lapis portfolio. Basically, what this is a framework to set up a multi-layered, diversified stream of passive income. Because too often, high-income professionals, they tend to become over-reliant on their incomes to support their lifestyle. But the truth is, these incomes will stop at some point, whether because of retirement or illness, burnt out, or even retrenchment. So it is crucial to build a set of well-diversified, coherent passive income streams that can step in to replace an active income so that when that stops, lifestyle doesn't have to.
And you're saying this needs little oversight? What about market volatility and economic downturn?
I think once we have these simple frameworks in place and we set it up right from the start, there is actually very little that you need to actively monitor on a day-to-day basis. Of course, when major things change, for example, if COVID-19 happens again, then there is a need to reevaluate if your portfolio still makes sense, whether the fundamentals are still robust. But I think aside from that, which is usually a black swan event once every 10 years or so, the real variable to measure is really yourself. And what I mean by that is really any changes to your circumstances or your priorities that would warrant a change in the portfolio strategy. So for example, I have a client. When I first started working with him, he was in his 40s, high achiever, he was married with no kids and with no plans to have any. So his only focus really was to retire by 50 and to maintain his aspirational lifestyle, as well as build a seed fund for future business ventures. However, life threw him a curveball. His wife got pregnant, which is good news. Naturally, his priorities shifted. So instead of just a singular focus on early retirement, it expanded to include education funding for his child, ensuring healthcare access, as well as long-term security for the child. So priorities do evolve, and it's important that our investment strategy evolves accordingly. I always say the real measure of success of an investment portfolio is whether it supports the life that we want to live, and not so much just in terms of how much returns we are getting.
Beyond traditional investments, are there alternative financial opportunities or strategies for busy professionals seeking efficient growth?
So I think it's helpful to first define what we mean by traditional investments, which would be the alternative to alternatives. So when I refer to traditional investments, I'm actually referring to public market assets, things like stocks and bonds. So assets that primarily are influenced by market sentiment and institutional cash flows. Alternatives, on the other hand, are assets that don't move in lockstep with markets. Private equity, which means direct investments into private companies, or even private credit, which is direct lending to private companies. Alternatively, you could also invest in more niche areas like music royalties or even catastrophe insurance. So these are assets that could still be public, but they are not tied to macroeconomic cycles. So they provide a diversifier to market volatility. However, the thing to understand about alternatives is that they tend to sacrifice liquidity. Unlike public markets, you can't just sell on the click of a button. The right mix of assets to put into a portfolio for efficient growth really depends on what your priorities are, whether that is stability of the portfolio, access to liquidity, or the highest potential returns.
And the one piece of advice you would leave us with?
Okay, one piece of advice. I would say it's really the most important thing. The starting point would be to have clarity of your goals, understand what the attendant time horizons are, as well as your risk tolerance. And if I could just add a bonus to that, maybe work with a trusted advisor to figure out the rest of it. So how do you put in place a strategy to help you to achieve these goals?
She couldn't help herself. Takeaway order, Money Hacks 236 is up. Don't let a busy schedule derail your wealth goals. Discover how clarity, a sound strategy, and a long-term view can turn market noise into financial freedom. Plus, simplify with systematic reviews, automation, and a trusted advisor. Because your money should work for you, not the other way around. A big thank you to Grace Tay, Associate Director at Finexis Advisory.
Thank you, Howie.
I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.